This slide introduces the topic of financials. The title Financials is prominently displayed in white text against a black background, with the Affirm logo visible in the bottom right corner. This slide serves as an introductory page for the upcoming detailed financial data analysis. We will delve into the company's current standing and future prospects through in-depth examination of its financial performance, profit and loss statements, and cash flow information. Let's examine the components of interest income by quarter. First, interest income on unpaid principal balance, starting at $273.581 million on March 31, 2024, shows a steady increasing trend, expected to rise to $465.786 million by March 31, 2026. This could be related to an increase in the company's loan asset size or rising loan interest rates. The amortization of discount on loans held for investment fluctuates slightly, remaining at a relatively stable level from $53.960 million on March 31, 2024. On the other hand, amortization of premiums on loans is shown in negative figures, indicating costs incurred when loans are repaid at a higher value than their initial value, and the magnitude of this amount is gradually increasing. Finally, interest receivable charged off, net of recoveries, consistently shows an increasing negative value over time. This signifies that the charged-off interest amounts are greater than the recovered amounts, which could act as a potential risk factor. The total interest income, summing up all these items, shows a steady growth from $315.712 million on March 31, 2024, to $532.449 million by March 31, 2026. This slide details the company's share count, specifically the fully diluted shares outstanding, which includes common shares plus any potential shares from options, warrants, and restricted stock units. We start with 335 million common shares outstanding. Then, we add 10 million shares from options, with a weighted average strike price of $19.49. Next, 4 million shares from vested warrants are added, having a weighted average strike price of $5.51. Additionally, 2 million shares from CEO Value Creation Awards and 10 million restricted stock units are included. However, a treasury stock reduction of 5 million shares from options and vested warrants is subtracted to account for shares the company holds. When all these factors are combined, the fully diluted shares outstanding, calculated using the treasury stock method as of the end of fiscal Q3 2026, amounts to 356 million shares. This figure is crucial for earnings per share calculations and warrants close attention from investors. This chart illustrates the quarterly trend of share-based payment expenses from Q3 FY23 to Q3 FY26. Employee stock-based compensation, shown in purple, constitutes the largest portion, exhibiting an upward trend from $64 million in Q3 FY23 to $80 million in Q1 FY26, with a notable increase in Q1 FY26. Amazon Commercial Agreement asset amortization, in light green, is decreasing from $96 million in Q3 FY23 to $40 million in Q3 FY26. The CEO Value Creation Award, light purple, and Shopify Commercial Agreement asset amortization, orange, represent smaller, more volatile components. Total share-based payment expenses decreased from $179 million in Q1 FY24 to $123 million in Q2 FY25 before rising again to $135 million in Q1 FY26. This data suggests that the company utilizes a significant amount of equity compensation for talent retention and growth, with a notable focus on core personnel. However, the decline in Amazon Commercial Agreement expenses could reflect the termination or reassessment of those agreements, potentially impacting future cost structures. The adjusted operating income figures at the top, $264 million, $337 million, $281 million, indirectly indicate the impact of these compensation expenses on operating performance. Overall, The trend and changes in the components of share-based payment expenses serve as a crucial indicator for understanding the company's management strategy and financial health. Let's now delve into the quarterly revenue and transaction cost details. First, the gross merchandise value, GMV, shows a consistent upward trend, increasing from $6.294 billion on March 31, 2024, to $11.562 billion by March 31, 2026. This indicates overall platform growth. On the revenue side, total net revenue significantly rose from $576.157 million on March 31, 2024, to $1.038.765 billion by March 31, 2026. Notably, merchant network revenue is the primary driver, constituting between 2.3% and 2.5% of total revenue. Interest income also shows steady growth, contributing to revenue diversification. However, examining transaction costs, we observe an increasing trend in loss provisions and funding costs. The total transaction cost ratio, which was 5.5% on March 31, 2024, slightly decreased to 4.7% by March 31, 2026. Taken together, these trends suggest that the company is maintaining revenue growth while also focusing on managing transaction costs. This chart details the annual revenue and transaction costs. Notably, total revenue has steadily increased from $1,587,985 million for the year ended June 30, 2023, to $2,322,999 million for the year ended June 30, 2024, and further to $3,224,412 million for the year ended June 30, 2025. Specifically, card network revenue has nearly doubled, growing from $119,338 million in 2023 to $231,308 million in 2025. However, total transaction costs have also risen significantly, from $912,481 million in 2023 to $1,742,247 million in 2025. Consequently, revenue less transaction costs has more than doubled, growing from $675,504 million in 2023 to $1,482,165 million in 2025, indicating continued positive growth. Examining the line items as a percentage of GMV, the net revenue as a percentage of total revenue has increased from 3.3% in 2023 to 4% in 2025. Suggesting an improvement in profitability. This slide presents the reconciliations within the income statement. First, let's observe the total revenue, which shows a consistent upward trend from $576,157 as of March 31, 2025, to $1,038,765 as of March 31, 2026. However, operating expenses have also steadily increased, rising from $736,946 as of March 31, 2025, to $950,337 as of March 31, 2026. Consequently, the operating income loss shows a decreasing trend in losses, from a loss of $160,789 on March 31, 2025, to a loss of $88,429 on March 31, 2026. Notably, the technology and data analytics expenses saw a significant increase from $124,828 on March 31, 2025, to $191,619 on March 31, 2026, indicating the company's active investment in technology. Furthermore, restructuring and other expenses surged from $5,203 on March 31, 2025, to $145,304 on March 31, 2026, which, as explained in Note 1, reflects costs associated with acquisitions and other exit and disposal activities. Considering these expense variations, the adjusted operating income improved substantially from $78,506 on March 31, 2025, to $280,775 on March 31, 2026. This figure can be considered a clearer indicator of the core business's profitability. This income statement reconciliation analyzes total revenue, operating expenses, and operating income year over year. Total revenue increased significantly from $1,587.98 million as of June 30, 2023, to $3,224.41 million by June 30, 2025. While total operating expenses also rose from $2,788.84 million to $3,311.68 million during the same period, the revenue growth outpaced expense growth, leading to a substantial reduction in operating losses, from minus $1,200.86 million in 2023 to minus $87.27 million in 2025. Notably, the reconciliation of revenue less transaction costs, excluding provisions, shows considerable improvement, growing from $675.50 million in 2023 to $1,482.16 million in 2025. This trend indicates a gradual improvement in the company's profitability and can be seen as a positive signal for future investment decisions. This table compares GAAP, generally accepted accounting principles, expenses with non-GAAP expenses for the 3 months ended March 31, 2026, illustrating the differences in each category. Total operating expenses under GAAP are $950,337, but after adjusting for specific items such as D&A, stock-based compensation expense, enterprise warrant and share-based expenses, restructuring and other costs, the total operating expenses under non-GAAP significantly decreased to $757,992. This indicates that non-GAAP measures can provide a clearer view of operating performance to investors, particularly noting substantial adjustments in stock-based compensation expense and enterprise warrant and share-based expenses. Understanding these differences is crucial for accurately assessing a company's financial health. This slide presents the expense reconciliations between GAAP and non-GAAP measures. The top table displays data for the 3 months ended December 31, 2025, while the bottom table shows the 3 months ended September 30, 2023. A key observation is that total operating expenses under GAAP were $1,005,393 for the quarter ended December 31, 2025, but decreased to $786,040 on a non-GAAP basis, a reduction of approximately 22%. This variance stems primarily from stock-based compensation expense, enterprise warrant and share-based expenses, and restructuring and other costs. Notably, for the quarter ended December 31, 2025, technology and data analytics, sales and marketing, and general and administrative expenses were significantly lower on a non-GAAP basis compared to GAAP, indicating these items were excluded or revalued during non-GAAP adjustments. Examining the quarter ended September 30, 2023, in the lower table, GAAP total operating expenses were $869,676, with non-GAAP expenses at $669,462, also showing a substantial difference. The fact that non-GAAP expenses are lower than GAAP expenses in both periods suggests the company's intention to present a clearer view of its profitability by excluding certain non-cash or one-time items. Investors should carefully consider whether these adjustments are temporary or represent structural factors impacting the company's underlying profitability. This slide presents a reconciliation of GAAP, generally accepted accounting principles, expenses to non-GAAP expenses. The top table details the performance for the quarter ended June 30, 2025, while the bottom table shows the quarter ended March 31, 2025. Non-GAAP expenses are calculated by excluding or adjusting certain items, such as stock-based compensation expense, enterprise warrant and share-based expenses, restructuring and other costs. For the second quarter of 2025, total GAAP operating expenses were $818,353,000, which adjusted to $639,417,000 on a non-GAAP basis, a difference of approximately $178,936,000. This indicates that significant adjustments were made, primarily related to stock-based compensation expense and enterprise warrant and share-based expenses. These non-GAAP figures can help investors gain a clearer view of a company's core operational performance, especially when highlighting the non-recurring nature of certain expense items. This slide presents a reconciliation of expenses between GAAP, generally accepted accounting principles, and non-GAAP measures. For the 3 months ended December 31, 2024, total operating expenses under GAAP were $870,703,000. When adjusted to a non-GAAP basis, this figure reduces to $628,563,000. This decrease is primarily driven by differences in the restructuring and other costs line items. Notably, restructuring and other expenses of $60,000 were included under GAAP but excluded from non-GAAP. These adjustments are typically made to provide a clearer view of the company's core operational performance. Moving on to the data for the 3 months ended September 30, 2024, the total operating expenses under GAAP were $831,102,000, significantly lower on a non-GAAP basis at $568,890,000. In this period, $255,000 was deducted for restructuring and other, indicating the company has excluded certain one-time costs related to restructuring activities from its non-GAAP metrics. Analyzing these non-GAAP figures allows investors to focus more on the company's ongoing operational performance and better understand its underlying profitability, excluding the impact of one-time or non-recurring items. This slide presents a reconciliation of expenses between GAAP and non-GAAP for the second half of 2024, H2 Foot 24. Firstly, for the quarter ended June 30, 2024, or Q2, total operating expenses under GAAP were $732,645,000. However, on a non-GAAP basis, this figure decreased to $509,378,000, a reduction of approximately $223,267,000. This variance is primarily due to adjustments in stock-based compensation expense, $64,913,000, enterprise warrant and share-based expenses, $114,226,000, and D&A-related costs, $44,284,000. Notably, the restructuring and other category incurred an expense of $156,000 under GAAP, which was excluded in the non-GAAP figures. Next, for the quarter ended March 31, 2024, or Q1, total operating expenses under GAAP stood at $736,946,000. On a non-GAAP basis, this amounted to $497,651,000, indicating a slight increase in the magnitude of adjustments compared to Q2. In Q1 as well, adjustments were made for stock-based compensation expense, $77,075,000, and enterprise warrant and share-based expenses, $111,829,000, along with D&A-related costs of $45,189,000. The restructuring and other category saw an exclusion of $5,203,000 in the non-GAAP calculation. Overall, it is evident that substantial adjustments have been consistently made for stock-based compensation expense and enterprise warrant and share-based expenses throughout the first half of 2024. These non-GAAP metrics, which exclude items like stock-based compensation and certain one-time expenses, are designed to provide a clearer view of the company's core business performance, helping investors assess the underlying profitability of the business. This slide presents a quarterly reconciliation of expenses between GAAP, generally accepted accounting principles, and non-GAAP, adjusted accounting principles. Let's first examine the quarter ended December 31, 2023. Total operating expenses under GAAP were $763,261,000, but were adjusted to $498,502,000 on a non-GAAP basis after excluding items such as stock-based compensation expense, enterprise warrant and share-based expenses, and restructuring and other costs. Notably, stock-based compensation expense and enterprise warrant and share-based expenses are recognized to some extent under GAAP but are often excluded in non-GAAP. Moving to the quarter ended September 30, 2023, total operating expenses under GAAP were $705,994,000, adjusted to $436,603,000 on a non-GAAP basis. In both quarters, expenses tend to decrease when adjusted from GAAP to non-GAAP, which can help investors gain a clearer understanding of the company's core operating performance. Analyzing these adjustments from multiple perspectives can provide insights into the company's financial health. This slide presents a reconciliation of GAAP, generally accepted accounting principles, to non-GAAP expense figures for H2 '23. Let's first examine the 3 months ended June 30, 2023. Under GAAP, total transaction costs amounted to $263,747, comprising loss on loan purchase commitment, provision for credit losses, funding costs, and processing and servicing. After adjustments for non-GAAP, these costs totaled $262,227, indicating a relatively small difference. Total operating expenses under GAAP were $689,653, which include technology and data analytics, sales and marketing, general and administrative, and restructuring and other expenses. This figure is adjusted to $431,116 for non-GAAP reporting. Notably, adjustments in categories like restructuring and other expenses create the divergence between GAAP and non-GAAP figures, reflecting specific accounting treatments. Moving to the 3 months ended March 31, 2023, total transaction costs under GAAP were $214,079, and total operating expenses were $691,013. For non-GAAP, total transaction costs adjusted to $212,859, and total operating expenses to $387,403. We observe a more significant adjustment for operating expenses in the more recent period when comparing non-GAAP to GAAP. This suggests the company aims to present a clearer view of its core operational performance through non-GAAP metrics. Investors should closely scrutinize the nature and trend of these adjustments to accurately assess the company's underlying profitability and financial health. This slide highlights the critical importance of understanding the differences between GAAP and non-GAAP financial reporting. This table provides a comparative analysis of expenses categorized under both GAAP and non-GAAP measures for fiscal years 24 and 25. Let's first examine the data for the 12 months ended June 30, 2025. Total operating expenses under GAAP amount to $3,311.69 million, while non-GAAP total operating expenses stand at $2,446.33 million, showing a difference of approximately $865.36 million. This discrepancy primarily arises from technology and data analytics and sales and marketing expenses, indicating adjustments or exclusions in these categories under the non-GAAP measure. Notably, the restructuring and other expense item shows a negative value of $183,000 under GAAP, which, according to the notes, represents expenses incurred in the period associated with the company's restructurings and other exit and disposal activities. Shifting to the 12 months ended June 30, 2024, total operating expenses under GAAP were $2,938.85 million, whereas the non-GAAP figure was $1,942.13 million, a difference of roughly $996.72 million. It is important to observe that while GAAP total operating expenses decreased from FY24 to FY25, the non-GAAP total operating expenses remained relatively consistent. This suggests that the company's expense management approaches may differ significantly from standard GAAP reporting. This slide presents the reconciliation of expenses from GAAP to non-GAAP for the 12 months ended June 30, 2023, by expense category. First, total operating expenses under GAAP were approximately $2.79 billion, which adjusts to approximately $1.66 billion under non-GAAP. Notably, there are significant differences between GAAP and non-GAAP for stock-based compensation expense and enterprise warrant and share-based expenses, where non-cash expenses of $451.71 million and $499.15 million, respectively, are excluded in non-GAAP. Additionally, adjustments of $35.87 million for restructuring and other and $8.58 million for other costs are made from GAAP to non-GAAP. These adjustments are intended to provide a clearer view of the company's core business performance, allowing investors to refer to these non-GAAP metrics when assessing the company's actual earnings power. Therefore, understanding these adjustments is crucial for a comprehensive financial analysis.